Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really excited to have you here today. Our objective in this show is to answer questions and be able to help people have a more successful retirement. So you can send your questions in now if you would like. You can send them in to asktom@talkmoneywithtom.com, which you can see here on the screen. And then you can also send them to our chat box if you want to, and we'll try to answer them also. You can send those emails during the week too. Give us a little time to get ready for them, and then of course we're available for consultation with clients. We have these strategy sessions every 6 months, and we get a lot of great questions that we use out of those sessions because we think everybody probably could benefit from some of these. So that's where all of this questions come from, and of course we believe that education is a big piece of what you can get out of this particular show, and that is important to be able to have a more successful retirement. So the Talk Money with Tom channel now has over 800 videos on it. You can subscribe to that channel. You hit the subscribe button. You can hit the little bell next to it, and you'll get notified whenever we put anything else on there. And then also, of course, if you'd like to, you can book an appointment and just set up a time to meet with us. You go to our website, hit the book appointment button up in the corner, pick a 30-minute video or phone time that works for you, and Issa and I will sit down with you and talk basically about your situation, sort of more of a custom, view of what happens, and just see, what we might be able to help you with. So really excited, looking forward to being able to help everybody today, and looking forward to, hopefully finding at least one question that you can use, to help yourself with your retirement, whether you're, 20 or looking forward to retirement, or 40 or, 70 already in retirement. I think a lot of these things apply to everybody as far as that goes. So. Okay, of course, I like to start off every show with a summary of kind of what I saw happening in the market this week. And if you take a look at this chart, you can see that this particular week that we have here right at the end is all green, very heavily up, really strong bounce off of last Friday. We hit a low last Friday for the year in the morning, rallied back actually all the way to a positive. And this week, for those of you that watch my daily videos where I summarize the market every day, Monday through Thursday, I have shirts that I wear. So I wear a green shirt when the market is up over, the S&P's up over 1.5%. And actually, this would have been the third green shirt day in a row, not in a row, but for this particular week, which is pretty rare. So really, really strong bounce that we're having, very broad-based and what have you too. So the first question I'll try to answer here is just, why are we having this bounce? We hit that low, okay, everybody's thinking things are going to go lower, and all of a sudden we're having this bounce. So let's take a look at that, and I'll show you at least some of my thoughts as to why this is happening. First of all, this is the American Association of Individual Investors Sentiment Survey. This is done every week. And you can see, the last 4 weeks here, just how many people feel that the market's going to be better in 6 months, or worse in 6 months, or neutral, right? So the better is green, and you can see, just example for this last week that just finished on Thursday, basically yesterday, it was only at 19.8%, right? So pretty low. Most people feel the market's going to go down. If you look at the bottom, the historical average is 38%. Last month, we had 3 weeks in a row where it was less than 20% of the people in the survey felt that the market was going to do better in 6 months. That's actually never happened in this survey since 1987. And the reason I bring this up is because when you get a huge number of people that think the market's going to do poorly, and they've all made their moves, they've gathered their cash. The fund managers right now have more cash than they've had since 9/11, according to the Bank of America survey and what have you. We've got, investors sitting on the sidelines. It doesn't take a lot to start it to move the other direction. And I know this seems really strange, but when enough people think the market's going to go down, it generally goes up. And that's, historically. So this is one of the things that you have to understand, to be a better investor, is this kind of, contrarian strategy with investment surveys and such. So here's one of the things I think that might be pushing it up. And this is a report that came out from JP Morgan yesterday. And so they're talking about corporate buybacks, right? And how much that's helping the market find its bottom, at least in their opinion. And so they estimated that the buybacks are 3 to 4 times higher than usual during this sell-off that we've been having. And so what's happening here, if you've got $429 billion worth of buybacks that have been announced by S&P 500 companies. So these are companies that are buying back their stock. And they're buying it back at higher rates as the market falls. I mean, they're buying the dip just like everybody else. And so if you have everybody that's already sold on one side, and then you have these corporations coming in and buying on the other side, all of a sudden you can have a pop and you can get some motion going. And then maybe that turns into something, long-term too, and we'll talk about that. But this corporate buybacks is a huge deal. It's one of the things that's really fascinating about it. I know like Apple, for example, announced a $90 billion corporate buyback. So it puts some support into the stock, and what have you too. So I like that. And it doesn't take a lot of volume to move the price back up when all the sellers have already left as far as that goes. So one of the other things we're seeing just in the last couple of weeks, insiders, specifically executives, and these are the people theoretically that know the most about their company, their buying has gone up. It's about 2 times average right now. And if you look at this chart, you can see when that's happened before, it was often these low points where the market pulled down quite a bit. And so for the most part, insiders are pretty good at when to buy. They see things happening within their companies. They see the price coming down to a level. They reach into their own pockets in general and they buy the stock. And so, there's a big saying that there's lots of reasons that executives would be selling stock, for diversification, want to buy a new vacation home, whatever it is. But there only really one main reason that they would be buying the stock, and that's because they think it's going to go higher, right? So that's a big deal too. So we have corporations buying back stock, we have executives buying back stock, we have massively negative sentiment in the investment world. Everybody thinks it's going to go down, so they're all out and they're waiting on the sidelines, and all of a sudden you're getting this run up. So really fascinating what's going on right now. And so we just had some reports that came out today that are really, I think, fascinating too, that are important, and that really popped the market this morning. This is called the Personal Consumption Expenditures Price Index. They call PCE. This is the preferred inflation measure that the Federal Reserve uses. We all talk about CPI, Consumer Price Index, which was 8.3%. The last report that came out for April. Well, the PCE was at 6.3%. And and you can see it came down, right? So still a lot higher than what the Federal Reserve wants. They really want to get 2 to 3%. So they're going to, come in and still be raising rates to try to bring that down. But the direction's important. It's coming down at this point in time. Now, this particular grouping of goods and services that they're using to find this gauge includes energy and food. Of course, one of the reasons that we saw these things drop in April is because gas came down in April, the price of gas. Now it's come back up in May too. So there is another measure called core PCE, where they take out energy, they take out food, and they look at the rest. And you can see that's actually even coming down at a faster rate as far as that goes. So prices are growing at a slower rate. That doesn't mean prices are getting cheaper. It basically means that the rate of inflation is slowing down. That's a huge deal because the Federal Reserve has really made a massive effort here to try to talk everything down. They're making mortgage rates go up. They're making the 10-year Treasury go up. They're making the stock market go down. They're raising rates. They're talking about raising rates. They're taking money off their balance sheets, all in a hope to do this. So if you actually start to see some results, the market loves this because it just means the Federal Reserve could maybe, stay on their path, not get more and more and more aggressive, like what we were seeing for the first part of this year when inflation just continued to go up no matter what happened. Now we're starting to see inflation slow down, right? So pretty critical. And then the other report that came out today was personal spending, which was up 0.9% for the month. You can see it was a little bit higher at other points of time during this year, but the average is about 0.5%. So we still have more than average personal spending going on. So even though prices have dropped, right, in terms of the amount of increase in price has dropped, we're still seeing consumers really healthy, really healthy consumers. Now, unfortunately, one of the things that needs to happen is you need consumer spending to slow down a bit. We actually did see that this month. You can see that in the chart here where there's a little bit of a slope or downward. But you don't want consumer spending to drop off completely because that's what kicks us into a recession. So those are the things that are happening. We've got this, very negative sentiment. We've got corporate and insider buying. We've got inflation numbers that seem to be peaking. So that's good. We'll see if that continues. And we got personal spending and consumer spending still great because 2/3 of the economic growth that happens is attributed to consumer spending. So really important. All of these reports came out today. So very, very, good day. And that's why the market's up so much as we speak. Now let's talk about what you want to do strategically right now in this particular market. I have different strategies for different markets. So when I have a market that's going up and there doesn't look to be any recession coming, we have one strategy of trying to find things that are trending on a momentum basis. When we're in a different market like we're here, where the market is coming down, but the recession is still not happening, even the early indicators aren't showing a recession yet for the most part, then you want to rebalance. And then there's another strategy when the recession is coming and the early indicators are showing, then you want to get defensive, right? So 3 different strategies. So we're in that middle strategy right now. We've been in that strategy, really since November. And what you want to do is have a very high quality portfolio that you rebalance. And so one of the things you have to have first is a gauge for recession. How do you know it's going to come? And I have a whole host of different indicators that I look at. This is one of my favorites. It's actually one of the most accurate recession indicators in advance, kind of that 7 to 10 months. And if you look here, closely, you can see, prior to the 90 recession there, it was 18 months in advance it peaked. Prior to the 2000 downturn, recession, it was 11 months, 21 months it peaked before the 2008. Right now, it actually peaked in March. It was down 0.3% in April. And in my studies looking back, I need to see at least 1% because it goes up and down. You can see it's actually had 1 month here and there. And so you can't react to it every single time it has any downturn at all. So we got to wait until it gets down 1%. So to me, I'm in this middle grouping of strategies where we do not have a recession coming yet. And so I want to rebalance. And so the second thing you really want to have there is a really high quality portfolio. Because what you're doing when you're rebalancing is essentially buying on the dip, which, can work great in a situation where the market comes down some and then recovers. You're kind of buying on these different pieces. But certain stocks could go down forever or even disappear. So a lot of the things that did really well in 2020, innovative technology, genomics, clean energy and what have you, I would be careful with areas of the market where they don't have good earnings. It's not a quality scenario. They have great future outlook and very bright future potentially, but right now they're not producing enough because what's going to lead us out of these downturns are high quality companies. So if you look real closely at what we've got here, we've got a giant piece of the total stock market index. So we're basically buying the whole market. A big piece of the S&P 500, which I think is a very good quality screen. Got some Microsoft and Apple, 2 companies that are fantastic at generating cash flow, have really good cash positions themselves. Some short-term real estate and some semiconductors, which have been coming down quite a bit, but very good quality companies in that particular index that I think will come back around, and they actually have been most recently, so we'll see how that plays out. And on the bond side, the same thing. You've got to have good quality, lots of diversification. Got total bond market index, treasury inflation protection securities on the short-term end, and an inflation hedged high yield, for example. So when you're rebalancing, you're selling whatever those pieces that kind of stayed up higher, and you're buying those pieces that came down lower. Again, you have to believe in all those pieces. Otherwise, you could be buying a piece that just keeps going down really forever, right? So you got to be careful here. And so got to know that there's a recession not coming. That's important because you don't want to keep rebalancing all the way down for a 50% downturn, right? Okay. The average downturn without a recession on the S&P 500 is 15%. If you do have a recession, the average downturn is 36%. And so that's why you really want to focus on that. And you got to have high quality when you're doing these rebalancing. So, all right, we've got that. Now, when do we rebalance, right? I have 2 main indicators that I use. One is called the VIX. And this is what we call a fear index. And so what happens with this is when the it's a short-term put call that's happening on the S&P 500. And essentially, without getting too complicated, when the number gets above 30, the fear is getting pretty high. And that's when you want to be buying. And so I put some little boxes around the 4 times where that got above 30, where we actually took action as far as that goes. You also want to see the market stretched to the downside. And so I use this relative strength index, a Wilder relative strength index. I want to see that at 30 or less. And again, I put 4 boxes where that happened, where we took action as far as that goes. And then what you end up with are these 4 rebalancing points. And so you can see, actually, they're really good rebalancing points. They were, at least at that point in time, really drawn down the 24th of January, the 24th of February, the 29th of April, and really, 2 weeks ago. So the one 2 weeks ago, is already at a profit. And when you're rebalancing, you're basically buying what's the lowest, and you're buying more shares, and you're bringing down your average cost per share. And so when things do recover, you get back to profitability faster by using these rebalancings. We do this mostly with retirement type assets because this can be really a problem from a standpoint of taxable accounts, because you can generate a lot of taxes here. But if you have an IRA or a 401k or those types of things, we don't have to worry about the taxes, and we can really kind of take advantage of that by doing these rebalancing. So that's the key piece there, So now the last part I think that's important to understand here, just going back to the S&P 500 itself and taking a look at this little tail that we have going on right now. I've been talking about this for a while, but what happens is you get some catalyst and the market starts to move upward. In my opinion, the catalyst that we had right here was that we were at an extreme stretch, 7 weeks in a row of downturn, which really hasn't happened since the 1930s. And so we got some buying that came in. All the sellers were out, and we got buying that came in. And then you normally will get some people that are shorting the market. And so they start to kind of freak out because they need the market to go down. If it goes up, they can have unlimited loss. And what they call covering their shorts means that they're actually buying the stock. And so that creates an upturn. And then all of a sudden you get the fund managers who are all sitting out there with more cash than they've had since 9/11, and they are competing against these indexes, like let's say the S&P 500. Well, right now cash is not beating the S&P 500. I don't think we've seen the institutional money come in yet, but that is the thing that would get us back on a real recovery and not just a bounce. But you will notice on this chart there was a big bounce at the end of March. And we had a really big run. And then it stopped and it got killed. And really, in my opinion, what happened there was, 2 things. Number one, China started locking down for COVID, right? And so that seems to be getting better now, or at least China's been able to do a better job than expected to keep productivity up, even within these lockdowns, by using what's called these closed loops. But secondly, the Federal Reserve came out and really started hammering, the concepts that they wanted to do, because the Federal Reserve would like to see the stock market not run up a ton, just because that's one of the things that causes people to spend money. When we all feel rich from our stock accounts and our houses going up, we spend more money. And so they need us to slow down a little bit. And so I wouldn't be surprised to see the Federal Reserve coming out here and talking aggressively again. But there is one difference between now and what happened back in the end of March, in that we are now actually seeing their preferred indicator for inflation go down. And so I don't think they're going to probably be quite as aggressive in their conversations. That might not scare the market as much, but we'll see. Watch what happens next week or the week after if the market does keep running. So really interesting time frame. Thank you for listening. I hope that this helps you understand a little bit of what's going on, this week and this year altogether. And look forward to talking to you again about it next week. All right, Eason, what do we have for questions?
So our first question is something that everyone's been kind of feeling is, why does this current downturn feel so much worse than the pandemic downturn?
Yeah. It's a difference in pain, right? I mean, the pandemic downturn was more like that sharp, short pain, right? That you get. I mean, it happens all the time. You do different things. Hurts a lot, but it's very short and you kind of forget about it quickly. versus kind of like a chronic pain, right? And those are really bad. I mean, I don't have that luckily, but I mean, I had a bad back for 3 weeks once. It was really awful. And so that's the difference. We had essentially peaked out on about the 20th of February 2020, and we bottomed out on the 23rd of March 2020. So basically a month. We dropped 35%. That's the fastest 35% drop in history. And it was unbelievable, because basically we were shutting down everything. It was looking like the next Great Depression that could happen. It was really scary. And the Federal Reserve, the Treasury, and Congress just started pumping money out. And altogether, I think it was about $10 trillion came out to support the economy that was basically closed. And the recovery was quite quick. I don't remember the exact month that we got back to the high again and started establishing new highs, but it wasn't very long, 3 to 6 months, someplace in there. And if you look at what's happening now, right, it's been 5 months of just, and then we get a big bounce at the end of March. It looks good. And then China locks down and the Federal Reserve keeps hammering. And then, okay, we get it. And we're in the middle of another bounce right now. And after a while, you're like, oh my goodness, is this really going to turn into something or not? And so it's an issue of time and this, unfortunately, this is a lot more like what happened in 2008, which was this started in October of 2007 and ended in March of 2009, right? So almost a year and a half. We had several nice recoveries. Oh, looks like we're getting up. And then, and we kept coming down. And again, that was a recessionary environment. Matter of fact, that was a financial crisis, which usually creates the biggest downturns. And that was the second biggest downturn, in the history, going back to 1900 anyway. So, that's why this feels more painful. It's only down 17%. It's down less than that now because it's recovered a bunch. But from kind of high to low, it got down almost 20 if you look at the very highest intraday to the very lowest intraday last Friday. And that's painful, but it's more the time that it's taken. It's more like chronic pain than sharp, short pain. So yeah, it's something to be anxious about. But that's the key. You got to hang in there.
Yeah, because when you think about it, if you start to expand your kind of time frame outside this 5 months, and we start going back to pre-pandemic to now, that's a really good run. And if you told someone, pre-pandemic they'd be at this point in the market, I think they'd be very happy.
Yeah.
The only reason we're kind of anchored to that high is why we're kind of anxious about this lower.
Yeah, that's something to think about not doing as a person. Picking the highest point you ever had in your accounts and bemoaning where you are, you're just torturing yourself. You're exactly right. Take a 3-year look and say, okay, over the last 36 months, what have I made? How do I feel about that? How have I performed versus the market, say, in that 3-year period? And it just puts it into more perspective. And you're exactly right. If you went back in a time machine to 3 years ago and you told this person you were going to make X on your accounts over the next 3 years, they would have been very happy with that. Not knowing that, oh, hey, we had a 35% drop in the stock market, in the pandemic, and now we're having this slow grinding, almost 20% stock market downturn. If you just told them those two, they'd be like, wow, that sounds awful. But they still end up with a reasonable rate of return over that 3-year period, right? You're right. It's one of those things that just has to be put in perspective. Don't lock into the highest value. You will actually, if you have a good quality portfolio, most likely get back to those highest values, but it could take a while. I remember when the Nasdaq hit 5,000 and then it got crushed in 2000 and 2099, 2000, and people thought it would never get back there. Now what is it, 15,000? I mean, it did. It took a while. It took 5 years or something for it to finally get back. But if you're really thinking only about that high point, you're just adding to your chronic pain. And it's a lot easier to look at the long term. And then we talked about this on the last show. It's even easier to really look at the Monte Carlo simulation inside your financial plan and see, what is your probability of success for your retirement at these levels. Are they still pretty good or not? And a lot of times they're not that bad because, again, it's looking at the rest of your life. And that's the best way to look at it. So look 3 years back and then look at Monte Carlo simulation for what it says for the rest of your life. I bet you your pain drops quite a bit, right?
Yeah.
And I think that's a big component of being a good investor, is finding ways to drive your pain down, because if your pain gets too high, you'll probably sell out at the bottom, or close enough to it, and you'll end up with a return that you really, really don't like. So anyway, that's a good question.
So another question that's kind of related to this downturn is, my 401k is down substantially. Should I be doing anything to manage it or to fix it?
Yeah, actually, I've seen several articles about this where the 401ks are obviously down. The market's down, and people are trying to manage their 401ks on their own, and what do they do and how do they look at it? So number one, in my opinion, would be just the fact that, and this is something I always try to remind clients of, the one thing about a 401k or a 403b or a 457 plan, or all these plans that are kind of attached to employment, you are putting money into those most likely every paycheck, for most plans. And you're also maybe getting a match. Your company's putting money in there. And so and if you're not retired yet, this drop that we're having, you're actually buying, more and more shares for the same dollar amount all the way down. And when it finally turns around, that looks pretty good.
Yeah.
I mean, you're lowering your average price per share for those holdings that you're buying, because you're buying and buying and buying. So 401ks are really powerful for that dollar cost averaging impact. And so just keep that in mind, and maybe kind of at least temporarily celebrate the fact that it's down, because you're buying more shares with the same dollar amounts, with the thought process that it's going to come back, at some point in time. And hopefully you've identified the right mixture that isn't exceeding your risk tolerance and making you really lose sleep, because that's a problem. So you do need to start off with making sure you've got the right amount of risk in your 401k. And then when it drops, you just keep on buying. All right. So the next thing I'd take a look at is really the thought process of professional management. I know this is self-serving because this is what we do. I just read a headline about the average individual investor in this downturn is down 32%. Wow. I mean, the S&P 500 was down 20 from high to low. And so the average individual investor is doing worse. And there's lots of reasons for that. Mostly that people just go running off into things that are working really well, and then they kind of fall in love with them, and then they don't make adjustments, or they don't even look sometimes enough. If you don't pay attention, sometimes that can be things can decay. You got the wrong things in your portfolio, whatever. So you can hire a professional, like us, to manage your 401k. And then, we have that experience of doing this every single day for the last 30 some odd years. And, when we're supposed to be, rebalancing, and when, what portfolio you should have, when we have a whole process to try to figure out somebody's risk tolerance and figure out which portfolio mixture would match that risk tolerance. And so we would start off, in most cases, working within the list of companies or investments that somebody has inside their 401k, for example. And then we basically make those trades. And, we can't do anything else in a 401k, but we can manage that 401k. We charge a fee, but that's, theoretically, if things go the right direction, we pay for ourselves, right? Because we're able to maybe manage the money better than the individual. The other thing that's really, really fascinating right now is that a lot of these 401ks have that ability to use what's called a self-directed 401k. And so you would move it out of the traditional 401k list of holdings out into kind of a brokerage account. Sometimes they call it a brokerage window, brokerage link. They have a lot of different names for it. But what it really means is that then you can buy anything, all right? Which honestly could be worse for the average investor, because they go off and buy, all these things that are getting crushed to down 80% from their highs back in 2020 or whatever. But for us, it opens up doors to be able to really do some fantastic things, because you can do, really, really high quality investments. You can do rebalancing inside of that. We can buy Vanguard and iShares, and so we can mix different companies that you don't often see. I mean, what do we have? Maybe 3,000 choices between individual stocks and exchange traded funds, for example, that we look at, versus a list inside the regular 401k that might be 20, 30, 40, right? We can do ESG portfolios, environmental, social, and governance portfolios. in those brokerage windows that you can't do, in a normal. So there's all kinds of interesting things that you can do there. And so anyway, that would be one of the things to think about, is who's managing your 401k? Are you managing it? How much time do you put in it? How much confidence do you have? And I've met people that are really good, so I don't have a problem with that. But I've also met a lot of people that aren't, as good, because they just don't have the time. I mean, they're busy, they're working, they have other interests, and their 401ks are getting bigger and bigger. So it's becoming more of a problem. A 10% downturn on $1 million 401k is really painful to watch. So, making sure that you've got the right piece, and I think it gives you some peace of mind personally. But anyway, that's how I would look at the 401k piece. I mean, what do you think?
Yeah, especially I think when you're starting out, or like a target date is a really good option because it really helps. It's managed, it kind of adjusts for your risk. But when you start to get those larger amounts, are you having the right parachute for your equities? Bonds, overall bonds this year have not done well. But if you're in short-term bonds, you've done much better. So having that ability to pick and choose, asset classes within asset classes is important.
Yeah, it's a good point. I mean, if you have $5,000 in a 401k, it's not the same as having $5 million, right? I mean, so and so that smaller dollar amount, you can definitely use something like the target funds. I don't know that I would do that for the $5 million as much personally, because for example, there's a ton of international exposure right now in those, and that's not doing very well. And so there's some things that I might change, if I had a choice. But that's a good point. Size of the portfolio and size of 401k or retirement plan does make a difference. Good. What else do we have?
So our next question is, do you think the Federal Reserve is trying to slow down the stock market? And if they do that, what would happen?
Yeah. So there's been several articles on this and different speakers at conferences talking about the fact that they feel like the Federal Reserve is sort of purposely targeting. It's a little controversial as to whether they are or not. But I will say you could see why they might want to. And the reason is, and I've seen this many places, the two big drivers of consumer behavior are house price increases and stock market increases. And so when those are both up and going up and up and up, people want to spend more. And of course, the Federal Reserve is trying to slow down demand until supply can catch up, so we can get this inflation, especially core inflation and this PCE inflation, back down to that 2 to 3% range that they're looking at. That one stat that keeps running through my head is that household wealth in the U.S. from the bottom of the market in March of 2020 to the end of last year grew $36 trillion, right? And so, hey, there's no question as to why we have all of this spending going on when there's that kind of growth. And so the Federal Reserve, of course, is going to raise rates, which can make the market kind of rocky all by itself. But what's been more suspicious is how drastically they have changed their verbiage and how aggressive they've been with their verbiage. They used to be much more careful about what they said and how they said, because I don't know, I watch the minute-by-minute charts, and when the Federal Reserve Chairman Powell is speaking, or one of the other chairmen of the Federal Reserve board members, you can see the impact. I mean, the market cares dramatically about what the Federal Reserve has to say. And so they've been saying things that have been really hammering the market. And I think it's also a little bit suspicious that a lot of times when we've had big run-ups, all of a sudden we have an interview with somebody who starts again talking aggressively. So they might be putting a cap on the market. My hope is that because we have seen today, right, the core PCE, personal consumption expenditure price index, dropped, the overall PCE price index dropped, right? Those are the two areas that the Federal Reserve looks at the most. They're really trying to slow down job openings. We haven't seen that yet, but maybe that starts. I'm hoping that some of these things that they're trying to accomplish have peaked out and we're on the right trend, and maybe they can back up a little bit on some of their rhetoric, right? And keep on. The market's okay with the path we're on. It's just the situation of, oh, hey, we're going to have 2 half-point rate increases, and then they come out and say, no, we're going to actually do 0.75 or 1%, or and then the market's going to adjust down. So if they really want to bring down the market, that's exactly what they'd come out and do. Next week, the week after, one of the Fed governors would come out and say, we're still looking at 0.75. And so, and the market has to respond to that, usually by readjusting to the downside. So anyway, I don't know if that's true or not, or if they're really going after it, but it makes some sense that they would.
Yeah.
Right? Because they need to bring down personal spending, at least to a certain degree. The danger is, of course, they bring all this stuff down too much, kick us into recession, and then you've got a whole different stock market issue, that's happening. And then that's the fear that the market's dealing with right now.
So when you think about how spending actually went up while the price went down, so does the Fed be okay with spending going up while prices are coming down? Are they
That's
happy
a
with
perfect scenario for the Fed. They would love that, right? I mean, what that means is that most likely, I was thinking about that today, because this is a great point. Spending is up. It was up higher than expected. And then the core PE, not even counting food and energy, which are really, a wild card right now, but core PE dropped, and dropped more than expected, year over year especially. And so what happens there is that we've got this scenario. How did it drop if spending's still high? Because essentially that means demand is still there, because there's only two reasons I can think of. Number one is supply is picking up and is still coming in and slowly but surely, even with China's problems, supply is better this April than last April. I could see that, right? I can see that. We've heard lots of good things about the ports and trucking and different things that are getting better, and those type of things as far as that goes. The other thing is that you might have companies that aren't raising their prices as much, and we certainly saw that with like Target and Walmart when they came out with their earnings reports over the last couple of weeks. They missed their earnings, and really what happens is their costs went up, and they didn't make their prices at their stores or website go up. And so there is some compression of earnings in that scenario for some companies. And so those two things are maybe slowing it down, even though spending is still there, at least in my opinion. So that's a perfect situation for the Fed as far as I'm concerned. Compression of earnings could be an issue long term, right? I don't think the Fed wants to see that happen drastically, because that's a recessionary signal, at some point in time. And the market responded quite negatively to that, especially the Target miss, right, last week. So Target's had a nice little bounce coming back because a good company, maybe it oversold, but nonetheless, I think that's a good thing. And the market is responding today. At least, we're live right now, so I don't know where the market is. But, the market has responded, just before the show started, was up quite a bit. It was, like I say, it was a green shirt day, which is fantastic. All right.
So our next question is, how do I avoid investing in like gun-related companies if I'm buying big, mutual funds or ETFs where I'm kind of just buying a basket of investments? How can I screen my investments?
So you said gun-related companies?
Yeah.
Oh, yeah. Well, it's kind of interesting. There aren't that many. The actual gun manufacturers have mostly gone private, just because they were getting hammered in the public market. There's still some, and they buried themselves inside of these outdoor manufacturing companies and that type of stuff. The pure play where you used to be able to just take guns out of your portfolio is a little bit harder. I mean, Walmart is a big seller. Dick's Sporting Goods has been a big seller of guns, and so those are now considered gun related. Yeah. It's interesting. For most accounts, we don't see just a whole bunch of individual stocks, because then you could avoid it quite easily. I'm going to buy these 20 stocks, and I'm going to make sure that there's no gun related pieces. That's not the norm. The norm is it's a bunch of mutual funds or exchange traded funds, which are baskets of stocks, and you've got hundreds, if not thousands, of different ones in there, and you could end up with some of the companies that are gun related in that way. And I think the easiest way to avoid that is these new ish ESG. In our case, ETFs, right? I mean, there's mutual funds too, but we use ETFs, and I think the biggest growth in the ESG area has been ETFs. So let me dissect that word salad. So ESG is environmental, social, and governance. So they look at companies on how they impact the environment, how they impact their community, and how the governance is the makeup of their board and how they impact their employees, right? And there's a rating system. And so, every company, for the most part, is given a number, and then an ETF is an exchange traded fund. It's just a basket of stocks. Like you can buy the S&P 500 in an exchange traded fund. You've got all 500 stocks from the S&P, right? Well, if they put an ESG screen on that, and you can take the S&P 500 and buy one that has an ESG screen, it just means that they won't buy these companies that don't meet that particular number. And sometimes you'll have also on top of that specific things that they're avoiding. So if you want to, and we have ESG portfolios, and they're quite popular actually, and if you want to create a portfolio that doesn't have gun exposure, you can go in and find the ESG ETFs, and some of them specifically avoid gun exposure. So it's kind of a dual thing. One is, have to reach a certain ESG number, and then but we still also eliminate this, and this. And I've seen all kinds of things. Palm oil. Gun related, all these different areas, right? And so they're all a little different. You have to take a little time to do some research to figure out, which ones specifically call out no guns, and or look at those ones that are just using the number, because that happens sometimes too. And make sure that there's none of the gun things that made it through that screen, right? And so I think that's the answer to the question of how you would, avoid guns in your portfolio. And again, this is a controversial subject, and I'm not trying to say one way or another what you should do or shouldn't do or what have you. I'm just telling you it's available. It's something you can do if you so desire. We've created entire portfolios, that pie chart thing that I'm always showing, where every piece is an ESG screened, component. And, so that can be done. You can create a nice diversified portfolio that doesn't have some pieces in it that you don't want.
Yeah, and you could do this for kind of any major, political issue. You could say, I don't want big oil in my thing. A lot of ESG portfolios don't have any kind of oil companies or any kind of gas companies as part of their portfolio.
Yeah, one thing to understand about ESG is the proliferation has been pretty large now. It's really coming on. Is there are a lot of different types. There are some that actually have oil in them, Exxon, for example. And so, but you want to it depends on what you want. But you can get some that are more restrictive. They become less diversified, but still hundreds and hundreds of stocks. But they have higher and higher bar to get involved into that portfolio. I would say there's kind of like three levels. One where it's just sort of a basic ESG screen, and then kind of that next level, and then you've got this kind of, I guess I'd call it advanced ESG, where they're really picking out some pieces that they're trying to eliminate as far as that goes. All right. Well, that's another show today. Thank you joining us for our live show. We really appreciate it. Feel free, again, to send in questions at any time that you'd like, for the next show. And then also, of course, you can set up an appointment with us that you can do by hitting the book appointment button. And you can subscribe to our channel by going to the subscribe button there and hitting the little bell next to it if you want to get notified. So look forward to being able to see you next week, and thank you very much for coming today.